Hello, this is the Chart Profit video. Approaching 2.5 hours into the trading day on the 20th of July. This from the pre-open today. This is the E-mini S&P. Two reference levels we've been watching over the last couple of weeks. One, 27.72, which is the minor controlling price. And over here last week, middle of last week, we found support at that price as described in the pre-open on Thursday. Prior to that, on the Tuesday the 10th, I said that yesterday's low came in at 27.72. That was overnight on the Monday. And I said here it would be fair to assume that yesterday's low at 27.72 should hold if this is effective buying, which occurred prior to this Wednesday. And that's what happened. That was a positive. We saw aggressive buying on the Thursday last week. And then we approached our second reference level, which is the 9-month value area high up at 28.01. And as I said, pre-open on this day, on Thursday, I note the value area high is at 28.01, and price acceptance or time at this level would be a positive, and we've actually seen that. So the market stalled in here a little bit. We're still kind of stalled in that area of price, but the last three value areas on Tuesday through Thursday have been generated above that level. So this isn't what I call a fast rejection, which can sometimes happen at one of these major value area highs. So from a technical aspect at least, there's not too many negatives. I want to see the market hold 27.72 on the E-mini. So in the short term, that's the support. Price below that level would be first indication of weakness in the near term, and in the longer term, as we've been saying, the big support is at 27.18. That's the 12-month controlling price. I've also been mentioning that since mid-April here, that was the last time that I marked significant selling, that red bar there. Since that point, we've had 9 days where I've marked aggressive buying, these green bars. And over that period, the market has moved higher, so this is pretty effective buying. We can also say that the pulse chart that we're looking at here has improved. The price momentum here back above zero late last week and heading higher, and the breadth in the middle here, our breadth indicator is green, which is good. So we have an improved pulse chart with evidence of significant buying. Outside of the technical indications, we can all think of some very good reasons why the market could suddenly run into trouble. We're not going to discuss those macro possibilities in here, but technically looks quite good, and I'm happy with the E-mini above 27.72. Not too much to report from the sentiment point of view, further to what was discussed last week. Actually, my version of the RIDEX assets ratio, as I wrote today, was higher at 23.85. That is actually the highest ratio since 29th of May. Historically, that is really high, not as high as 27.55, which is the highest ratio I have in the database recorded at the end of January. So that's the level to watch on the RIDEX ratio. In the public poll from AAII, the bulls percent fell to 34.7 this week. Bears percent was also lower at 24.9. 4-week moving average of the net bulls minus bears is almost at zero here. So right now we're pretty neutral. There's an indication here that the public aren't getting too excited about this further rally and this higher low on the chart here. If we look at the Investors Intelligence poll, that's the newsletter writers, bulls percent was actually higher this week, 55.3. Bears unchanged at 18.5. I follow a 4-week moving average of the net position, which is this black line here. Last significant indication was when we saw a multi-month low point for this indicator here, just kind of in here somewhere. Newsletter writers at their most bearish for many months. Market is higher from that point. For me, the most significant sentiment reading amongst the indicators I follow, in the Lipper US fund flows, they reported equity fund, including ETF inflows this week. So we have an inflow this week of 1.1 billion, the week to 18th of July. But here's the thing, that was the first net inflow in 7 weeks. So in the 6 weeks prior to that, we had net outflows each week. And this is the significant bit, the 4-week net outflow. So we follow the net flows on a 4-week rolling basis, and that is currently at 29 billion outflow. But here's the point, 2 weeks ago, that reached a negative 39.3 billion. That's the largest 4-week outflow I have in the database. That was here, this black line being the 4-week summation of flow. That was here on the chart. To the retail investor at this point, the average retail investor got very bearish in here, and this is real money, not opinion. As I said at the time, what this means is that if the market should continue to rally, this indicates bear fuel down here. Sentiment indicators are not perfect, they're certainly not the part of the analysis that I give priority to. Price is always the most important aspect, but at this point there was money on the sidelines and we had a net inflow this week. Quick look at the charts. This is the spider, important level, still 27, let's say 271.70, the 18 month in here. Russell 2000 IWM still outperforming on the longer term time frame. No really useful reference level close, but 1 year down here at 153.50. UK FTSE 100 index, again we're still looking at this unchanged 3-month level here at 77.11, and again this is certainly resistance on this chart. Much better to see the FTSE printing some time above that level, but you can clearly see how this index is still vastly underperforming previous 2 charts that I've shown for the US indices, as is the German DAX. Off a bit today at the end of this week. The 2-year still here, so it's in a relatively strong position, but definitely underperforming relatively. This is TLT, the T-bond ETF. At the end of this week, it's off here and may close below its major at 121. We were looking for a clear higher low above that level. We may not get that, and T-bonds may move back into position on the chart where it's difficult to take a view, which would be between the major at 121 and the 6-month down here at 118.50, which was previous support. This is the gold ETF, GLD. The major remains at 121, and if GLD is printing below that level, it's in a long-term weaker position. It's bounced back a little bit today as the dollar's come off. It's very oversold, and as I said last week, lots of good reasons from, let's say, the sentiment indicators suggest that gold could bounce from here, but as I also said, if price is below this level, 121, as long as it remains there and doesn't migrate lower, which it could, it hasn't yet, we are still in a weak price location, and really that may happen. We may see the controlling price fall, but until that happens, we have to say that price below 121 is a weak position. 12 months for USO, the oil fund ETF, remains at 12.79, and as I've been saying, in the longer term, as long as the price remains above that level, it's still strong. And now the dollar, this is the dollar index once again, frustrating those who try to take a view here, just oscillating around this 6-year, which is 94.80, and actually back below it at the end of this week, looking for a clear higher low above that level, or a clear lower high below that level. I'm finding the dollar, some of the pairs charts, just difficult right now. So here we have the pound, and there's a really important level quite locally here at 131.70, and we just say, okay, if the chart is below that level and that major doesn't move, which is unlikely right now, this is in a weak price location, so that's a tick for the dollar there. And we can say the same thing for the Euro FX chart. There was resistance here at the 1 year at 117.55, and we remain below that level, and this remains the controlling price over 1 year. So this remains resistance right now, and we're printing below it. So again, that's a tick for the dollar. You can see how easily these charts might change. Higher low above that level would give a really different picture. Okay, that concludes, and once again I thank you for watching.